Good day. You are welcome to my channel. This is Kevin Davis Accounting. So we are still continuing with our topic on the suspense accounts. And today we would like us to talk about how errors affecting the net profit. Now, you very well know that we talked about the errors, and sometimes as an accountant, these errors you might not spot them immediately, okay? And you're supposed to prepare final accounts. You know very well, after you preparing the trial balance, next you're supposed to prepare the final accounts. Sometimes, if you're lucky enough and you get to know these errors and you correct them before the final accounts, then you might come up with a net profit which is okay, which is correct. But sometimes you might find yourself that you're going to correct these errors after you have carried out or you have actually drafted the final accounts. Okay. Now, since you have done the final accounts already and you have got the net profit, remember the values that you have used or the figures that you have used have not been correct because there was some bit of errors that were performed here and there. So that means eventually even the net profit that we are going to get as a business is not going to be real. It's not going to be realistic. Why? Because it's coming from figures that had errors. Now, usually some accountants go back later on and go to the final accounts and also go back to trial balance and then trace out for these errors. So when they trace for these errors, then they are supposed to come back and they prepare what they call an adjusted net profit statement. So this statement is there to correct the errors that were previously made in the income statement that affected the net profit. Therefore, after you correcting those errors, you come back and then adjust the net profit. That means there's something, the net profit might be either more or less of the actual value. Now, because of that, you shall be required to prepare what they call the statement of the adjusted net profit, or what they call the statement of the corrected net profit. Now, it looks like this. Statement of adjusted net profit. Now, I'm going to have my Ugandan currency here, like this. Of course, we shall begin with the net profit. It will be given to us. They always give you a net profit, okay? They always give you the net profit in the question, and that net profit, of course, is what you're going to bring here. So the net profit as it is reported in the transaction or in the information given to you, you always bring it here. Now, after that, anything that reduces the value, okay, or an error that reduced the value of the net profit, we are going to come back here and we add it. Okay, for example, we are going to say add 1 incomes under stated. You bring it here. You very well know that if incomes are understated, okay, that means we are going to have a net profit which is less, okay, because if incomes are not the same level but they have been understated, they have been put down, that means we are reducing the net profit. So when incomes are understated, so it means that our net profit here is going to be less than the actual value. So if you find anything that is supposed to give income and is understated, okay, you're supposed to add it back, because we are looking at us verifying this net profit to make it correct. Okay, now since now incomes are understated, this one will reduce the net profit, we add them back. Then we bring our expenses also overstated. Okay, so we bring the value here. So you know very well that every time we overstate our expenses, remember it's going to be revenues, okay, minus expenses equals to the net profit. Okay, so if this is true, remember what I've just said, that if incomes, which are revenues, if they are understated, they are going to have the less value of the net profit. Okay, but still the opposite of this is us having expenses which are overstated. That means still our net profit will go down. So when you have revenues that are understated, you add them back. Now if you have expenses that are overstated, you bring them back as well. Then we also have our opening stock overcast. Overstated. Now, why am I saying opening stock overstated? Now, mind you, all the items that we are going to put in this statement of adjusted profit, these are elements, or these are things that make up the income statement. Anything concerning data as what, anything that goes to the balance sheet does not come here. Okay, we only bring items that only go in the income statement, that the items that come here. So when you have opening stock overstated, so it means that our cost of sales is going to be high. Okay, and if our cost of sales are high, then that means our net profit is going to reduce. Okay, so when you have opening stock overstated, you come back here and you add it back by the amount of money which has been overstated. So we are looking at us correcting this net profit value. So if you have opening stock and it's overstated, you bring it back here. Then you have closing stock understated. You come and put the value here. Now, still, if your closing stock is understated, it means still your cost of sales is going to be high. So that means it's reducing our net profit. So you add up all this and you bring it here like this. So you add the net profit plus this, you get your figure here. Now, what we have done here, we are going to make the opposite of it when we are lessing down. So we are going to say less. The first one is incomes understated. Here we come with incomes overstated. If you have incomes that are overstated, you bring them here. Remember, if incomes that are overstated, that means they are going to increase your net profit. Okay, and when they increase your net profit, it means you have an extra money which cannot be accounted for because you overstated your what? Your incomes. Then expenses undercast. So still, when your expenses are undercast, that means you're going to increase your net profit. So we come back here and we take it off. Then if our opening stock was overstated, here our opening stock has to be understated. You bring the value here as well, and then our closing stock overstated, like this. So what we do here, we get this total and we bring it here. So we subtract it, and the value shall get down here is what we call the adjusted or the corrected net profit. So this is the value that we shall call the adjusted net profit. So by us doing this, we shall be done with the statement of adjusted net profit. It is very, very easy. Now, when you're doing a number about correction of errors, you're going to be required to do two things. Okay? You'll be required to do what they call a suspense account. You'll be required to do the journals to correct the errors. And you also be required to make a statement of adjusted net profit. These are the three items that you're going to be required to do. Now, after you doing this, then you are done with the statement of adjusted net profit. Now, before I conclude, allow me to talk about the suspense account. Now, a suspense account is a temporary account. Okay, it's created when the accountant does not know where the money is going to. For example, if you have received money, you're going to maybe you're going to put into the cash book, but you don't know which account you're supposed to credit. Now, because you don't know the account you're supposed to credit, you might temporarily put this money into the suspense account as you wait on for the revelation of the true account where you should put that money. Now, the suspense account is a very temporary account, so it's just created momentarily or temporarily that is supposed to serve its purpose for a shorter period. Then later on, when you discover the actual account where you're supposed to put the other entry, then you can deal away with it. Now, the suspense account, it will look like just to the normal account. Usually, they're going to give you the difference. For example, the trial balance, they will say there was a difference of this, and they're going to say maybe the difference was put on the debit side, okay, of the suspense account. When you find such a statement, you always come here and say difference in books, and you bring it here. If they say the difference was put on the credit side of the suspense account, then you come and put it here like this. So as we move on with other errors, as we start correcting the errors, we start to use now the errors that affect the agreement of the trial balance. All of them will be corrected by the of suspense. Any error that affects the agreement of the trial balance, it will be corrected by the of the suspense account. So that means it has to go to the suspense account. Okay, and then the errors that do not affect the agreement of trial balance, for them they don't go to the suspense account. So at the end of the day, the suspense account has to close itself up. So that means you must get two figures which are the same here. When you add up all the transactions that you have put here and ones that you have put here, they should be the same. It should be a similar figure. So we are going to see this. I know it might not be understandable right now because of theoretical approaches and everything. I'm going to do a practical number in my next video. So I believe when I'm done with that number, your understanding will be enhanced. So thank you so much for watching. This is Kevin Davis Accounting. Until we meet again, it's a bye for now.